All right, so I'm going to be going over three pairs, gold, NAS, and AU. But for context, I'm going to pop to a daily chart so you understand where most of the decisions I'm making are coming from. So today is Tuesday. That's weekly opening price. I'm just going to mute everyone. There we go. Weekly opening price for NASDAQ. I'm expecting chop here. I'm expecting chop this entire week, which means I don't have a set drawn liquidity. Instead, I have a price range where I'm expecting the market to trade in. Why? I believe the upside draw for this bullish run has been met, and they're now taking profits since FOMC just dropped the confirmation that DXY is indeed going to be bearish for a while. I think there needs to be some amount of re-evaluation to determine if these positions are worth holding or are they going to be taking profits here. I'm leaning towards profit taking at these highs. So I believe every high created here is likely to be exit liquidity. So if they run higher, I don't think it's to be screaming higher this week in particular. I think any push above any daily highs are just to offset more longs, get in shorts, and offset more longs later. And you could confirm that with intraday price action. So if profit taking is going to happen and this is going to retrace, I'll be leaning primarily on the two things or two conditions that the market seeks in retracements. First one is going to be imbalances. And the second one would be internal liquidity. Now, I don't see any internal lows inside here to frame for liquidity. So if I wanted to go in and get an idea of where those are, I'd have to drop to a lower time frame. But for now, I'm looking at internal liquidity right here.
Kid, kid.
Hey.
Would you be thinking oh, come on, what's it called? Shoot, I forgot. Sorry.
Yeah, Kish, quick one, right? Like, price is rejecting with wicks right here, right? The concept is the next draw will be to the guy that rejected, I think, this particular candle. Yeah. It doesn't mean rejecting here is going to go to the closest DOL because this is a failure swing and this is a failure swing. Is that like a possibility?
Okay. So when you're looking at that idea, you want to first focus on the fact that you need a clear understanding of where is the drawn liquidity and the order flow. This, because right now I'm expecting this to chop, it could just chop. If we were bullish, and let's say the red line was my drawn liquidity, and we're closing above it, I'd be expecting higher prices. Based on this candle's high, if I had something on the left that says, I don't need to go, let me just put a line. Let's say this was my higher time frame drawn liquidity right there. And this day closed above one drawn liquidity, so I'm expecting higher prices, but then this failed to get here. Because this is a daily failure swing, the next thing in the order of delivery I'm expecting would be an opposing liquidity run. So when this day closes, I'm thinking sell side liquidity, then higher. This daily low becomes the first objective for sell side liquidity. If we close below here, I start looking for potential low. If it doesn't close below here, expect maybe a delayed delivery. Maybe this is the only thing they want. So then you start looking for, if this then that approaches. If this is going to go higher after this day close, what would get you involved in the move? Maybe it could happen and trade higher and we don't trade it. So I don't go in trying to justify or validate anything. I identify the order flow, identify the drawn liquidity, the likely market condition based on price action, and then it's all about confirmation. What do I want to see to get in? I don't care if it's moving without me. I don't care if it's going against me. I'm just looking for what do I need to see to confirm I could put risk on here. So I'm going to focus on those levels for now, right? Lots of stuff could happen inside here, but because of where this day closes, not really interested at the moment. So from here, I'd pop to a M5 and this is the day for me, right? All right, so let's take a look at the 2-day delivery that we have right here. All right, bam. $4M started here. So this day ran the old daily low. If this is the sell side liquidity and we're gonna go higher, I need to see a confirmed delivery that longs are coming in the market after 8 o'clock. If longs are coming in the market after 8 o'clock, where should the drawn liquidity be? Higher, above the weekly open. This is the weekly open here. Longs came in, then we ran higher. There is no willingness from price to expand above here. But I already expected that. I expected consolidation. So now the daily range moves to this low. For me and my model, this is now the daily range for this week. We could incorporate all of that. This is the range that the market's trading in. If I'm expecting it to chop and I still want to trade, my approach is going to be pretty simple. Look for shorts above equilibrium, look for longs below equilibrium with time. If I'm going to be shorting any market, like I mentioned on Twitter last week, there are only two things I want to see from price: a run on buy side or a premium array. This entire delivery between this low and this high is one-sided. I don't see any premium arrays that would make me comfortable. So if you're considering this to be an order block, yes, it is. But if I wait for this order block's low to be taken and look for a trade right here, I'm violating one of the requirements for me to trade here. This is discount. I'm not going to be selling below this order block here in discount. So this, it fits the rules for what I look for an order block, but it doesn't fit the rules for what's a high probability trade. So it doesn't matter what it does, I'd be leaving that alone. Which means if I can't find a premium array, I move to looking for buy side runs. This high was taken out here, up candle that took the high. I'm interested in selling when this candle's low is broken. So something like this, that's the low. This candle trades through right there. Let's put the stop at the high and then aim for low hanging objective, equilibrium. If price is trading low, through equilibrium, go all the way for the low. But I would be managing aggressively at 50% because that's realistic. So yeah, this is the daily range that we're playing in right now. We could extend this over all the way into today. Why? This push outside of the daily range, grab liquidity, came back inside. This, same idea. There is no reason for me to expect or anticipate anything beyond that. So I'm gonna push this all the way over to here. So going into today, my approach would be simple. Here's 4M open. Here's 8 o'clock. This FEG right here looks like the draw on liquidity for right now. But I wouldn't be expecting price to stop here. But this is why I wouldn't be doing anything and why I'm not doing anything this week. We're playing inside a daily range. 8 o'clock open in the premium portion of this daily range. Buy side liquidity has already been swept from the previous day. We had multiple attempts to trade higher and none of them went outside of, let me put this line on, the up candle at the high. Nothing went above that candle. So the most premium array inside this range for me is that candle. the most discounted array inside this range is going to be, we didn't take here. Let me submit this guy for review. I'll submit that for review. These are the two most discounted and premium arrays available in this market. This is equilibrium. I wouldn't be trading here. I would not be in this move, even though I could likely see that it's being drawn low. This is the old daily low. I'm just going to take it off. I don't think it's relevant anymore. Now, let's say that I'm bearish, or I had a bearish standpoint and I wanted to see this trade low. And I open my charts and this is what's available right now. How can I frame a trade? Well, since this is equilibrium of the range and there's a discount array at equilibrium, I would entertain the idea of this acting as short-term support, retracements, and then lower. So if this is going to retrace, where would it logically retrace to higher? Well, I can't see anything inside here that justifies price going higher. When we close right here at 12,470 on this feed, there is essentially nothing for this guy to trade up to. No inefficiencies, no imbalances, no nothing if we close below right here. So I don't see a high probability trade forming inside here unless it comes back to the order block. So what if this guy trades down here now and we close at that 12,470 and price takes that up candle's high? It becomes a discount array that I could potentially use to frame a short-term run to the upside. But if I'm going to be trading to the upside here, I need a logical target. I don't think it's sustainable to just pick arrays and then form fit targets for no good reason and then hope that they play out. Because this area, all of this, will be efficiently traded if we close below 12,470. I have no upside target. If we close here, 12,470, then price starts getting manipulated or distorted inside here. I haven't even checked the calendar because I had no intentions of trading. So let me do that right now. Yeah, calendar doesn't look very promising. There's a Fed chair speech at 12:40, but outside of that, just low probability, in my opinion. I'm not really doing much this week. So if I was watching this live, and we are, I'm looking at first thing, close below this FEG. Once we close below this FEG, higher prices or higher delivery should be permitted. Potentially, I'd look for the long, but I'm not really interested again. I don't think there's any high probability trading right here. Let's say a short idea did eventually form. My drawn liquidity would be the array right here, the discount array. Why? I'm expecting the market to consolidate. If I'm expecting the market to consolidate, internal arrays, internal liquidity should be what we get drawn to first. There can be spikes outside the range, but hoping for that is wishful thinking. So, yeah, this daily range using Monday London range for the week is something that, no, it's not using a specific session range. That's not a specific session range. But yeah, this is low probability trading. Going into this market and then trying to catch a short here or catch a reversal here is madness. It's absolutely madness. This is a old order block from the range low, the daily range low that I'm looking at right here. AU. All right, let's give this guy a break for a couple of minutes and then hop over to AU. It's 828. 830 should be a little bit sensitive because usually there's a whole lot happening at that time. AU daily chart. Those are the drawn liquidity for me. Let me pop on weekly open price. 0 GMT open price for the week. There we go. Okay. This was a little bit suspicious, in my opinion, because I think this was FOMC. FOMC said 25 basis points, DXY weakness. 1 day of bullishness, everybody who's trying to buy the news, crushed. So now I'm looking at where is this price likely drawn to? Since we've moved this much inside a daily range, the most logical assumption is that that's where we're trading. From this FEG low, well, yeah, this FEG low, that low, that's the high of the FEG. This FEG high to here should be the range that we're playing in. Here's equilibrium. Okay, cool. Once I found equilibrium, what's at equilibrium that would attract price? All daily lows, FEG, order block, all of that. So that's why those levels are marked. So now pop that off, hop to M5. Look at the delivery since Monday, which is here. Here we go. 4 AM open, we're above the weekly open price, and price trades lower. Everything above here is inefficient at this time. So let me do this. This high is not a high that's going to stay in the market. At 8 o'clock, this right here is inefficiently traded. So if I'm being more specific, between that and 4 AM opening price is inefficiently traded. We expanded lower, price keeps moving. Even at 10, price is still moving higher. This would be a day that I wouldn't trade. Because if I'm going to go short and I know this is inefficiently traded, I'm thinking sell this rebalance, or sell this. When price gets back here and fills in that range, look for a raise there. If we get back here, close above, creates an order block, look for that order block to push price lower. This is low probability. We got back to that point. Let's pull it out in time. Notice I'm not trying to form a daily range intraday for AU, since I'm already playing a higher time frame daily range. So the intraday liquidity should be highlighting where highs and lows and imbalances are resting for me. We close above this guy right there. This is price breaking through an efficiently traded range with speed. They're trying to break away from an efficiently traded price range. This gap is likely to stay open. If price closes below this, the state of delivery is bearish. And you go back to looking for, when I'm bearish, I want to see buy side run or premium raise. All you have to do is look for confirmation. You don't sell this run right here. So this here, when we close below, let me kind of put another box there to point that out. That. If this market is bullish and we broke above here with this much speed, this should stay open and price should continue higher. If for any reason price closes below here, you have to go back to being bearish. Then you switch to bearish protocol. And bearish, I want to see buy side run and premium raise. That's it. This happened sometime in London. So I'm going into the day expecting a bearish run. We open, we trade higher, all of this. This is before I would be comfortable trading, but I'd understand that this is a bearish run. Now I'd be looking for retracement ideas to go short. Where is the drawn liquidity? Let's see, bam, here, all the way down here. I'm gonna highlight this entire wick. My drawn liquidity will be right here. Not. While this is my drawn liquidity, I don't see an entry forming, which means I'd have to either allow this to play out without me or wait for a setup to form. But the drawn liquidity stays there for me. Assad. But yeah, that's the drawn liquidity. Now, if you are confident that this is your drawn liquidity, some persons are comfortable just selling right now and then just absorbing any potential risk or drawdown. I don't trade like that. I believe that if there is anything that says we could trade higher, it means I can wait. I can wait for a better entry. There is no FOMO here. And this low means nothing to me. Absolutely nothing. If they spike up inside here or retrace inside here, I would short that market. And then that's a drawn liquidity. But it would have to be getting back to here before tapping this. If the drawn liquidity is already taken, then I have no interest in looking for a continuation trade. What's happening here in the chat? So that's AU. So gold is the next one that I said I looked at. So as usual, nothing new. I'm gonna pop on weekly opening price. Same idea. Huge drop down. We're playing inside a daily consolidation. Here to here for my daily range.
Yeah, kid.
Hey,
Why is that your daily range?
right here. Why is this my daily
Yes,
range?
why do you pick from there to the top as your?
All right, let's take a look at it. This guy is trading higher. The low of a bullish move should be the origin of the move. Or there's no official name for this. I just call it something to not sound cool, but to give myself clarity when I'm looking for it. I call it engineered origin. So I'll show you an example of an engineered origin. And I think this is an engineered origin. By my definition is whenever there's a balanced price range and we break outside of that balanced price range, the breakaway gap that stays open will be used as origin. So let me draw some candles and then we'll look at some charts for some examples. So let's say this is a huge, wait, the color, man. Let's say this is a huge up candle. And here's another up candle. We have the wick and we have the wick of the previous candle. If this is a breakaway gap, here will all be efficiently traded. In a perfect world, a down candle is printed right here, and this gets used as origin of the move. So if you see price doing something like this, higher, and we already established that this gap should not be filled, then what would happen is they'd come down here, then go higher. If a down candle is printed right here, I'll use that down candle as my order block. If they come down here and create a down candle, I'll use that down candle as my order block. In this case, we broke above here. This is staying open. This down candle is the candidate for my order block. We traded above it here. This starts to move higher. That's my range low.
Right.
Okay.
Okay. So that's like order pairing.
Yeah.
in a sense,
It's order pairing at origin.
at origin. Right.
Yeah.
Okay.
All right. So,
Yeah, that's what I wanted to say on the NAS daily chart. I was going to ask if the draw wasn't the order pairing, because I kind of
this
saw
is not his
something.
daily chart. You're asking him
Yeah.
this right here is
So-
going to be the drawn liquidity.
Order pairing. Yeah, if that was order pairing, that's what I wanted to ask earlier.
Okay.
Right there.
If orders are being paired here, then the expectation would be that higher prices are coming next. I believe higher prices are coming next,
Right.
but I believe this week, today's Tuesday of the week, I believe this week should be a consolidation week. So because that's happening and next week is options expiry, my rules are telling me to stay out this week. Just allow them to create the range, then play the liquidity grab next week. In particular, Wednesday.
Right.
So in a perfect world, they don't trade back down here. They console, they trade higher, and then it crashes next week. Then they can do whatever they want on Thursday and Friday next week. Specifically Thursday and Friday next week. What's going on in the chat?
I have a quick question, please.
Hey, what's up?
Hey, what's up, Kish? You good?
Yeah, good.
Yeah, I'm loving the streams. I just wanted to ask you, you said that the engineered origin, right? In what case would we actually come and fill that?
When there's a change in the state of delivery.
Okay.
So
thanks.
Let me give you a classic example. This is the example that happens most often. Market's bullish, and here's a range, right? Here's a particular range. Could be any range, but let's say that's a range. We open in premium of the range, then expand higher. If this range is efficiently traded and we expand like this, there is no need to come back here. So this imbalance right here gets used as support, but this imbalance shouldn't be filled. So then that structure that we drew earlier, the big up candle, FEG is overlapping wicks right here. That gets used as support, then price trades higher. This is a repeating phenomenon. Every time, as long as we don't close below this FEG, the market stays bullish. I'm going to show you. I'll try to show you a couple of examples. So yeah, so if this was a daily range and we broke higher and there's a FEG that shouldn't stay open, I would welcome this retracement to the FEG in anticipation of this. Taking this high is the highest probability setup. So just picture this as a daily chart and we have a daily high here, daily FEG, we trade down, taps it right there. The fact that this high will get taken, trades I take inside here, I will hold. Partial, then allow for them to do what they're doing next. I think AU has one of them. I think. Take a look at this range inside here. So let's go from this down candle all the way to here. Take a look at that range. Up, down, up. All of this is efficiently traded. This here is the expansion that breaks outside of all of this. This is the imbalance right here. That should stay open. So I'm going to move this box now to the imbalance. There. If that should stay open, and this high that was created before this is high probability to get taken out, I generally don't aim for bodies. Well, I generally don't aim for wicks, I aim for bodies. But in a case like this, where this high is very likely to get taken out, you buy here and you hold for this. take the bulk of the position off here, allow them to do what they want to do. When this day closes like this, I would be uninterested in higher prices based on my rules. If the drawn
Yep.
liquidity is not taken with a close, anticipate opposing liquidity.
Retracement, opposing liquidity.
And then
Yeah.
this
So, Kish, another question, please. Do you consider so you don't consider a fair value gap filled if it's only wicks?
If it's only wicks, it can be filled. Wicks inside a fair value gap can fill it. If you're being meticulously
In
technical.
in this case, won't you consider that filled?
No,
Right.
partially filled.
Oh, because there's okay, okay, got you.
But this is only if you're trying to be absolutely meticulous. But yeah.
Right. Okay.
On the same AU, right? Can you go to like the M1, please?
Okay, what are we looking at?
Are we looking for like order pairing? Is that like the idea that's playing out between 4 to 8.15? This guy that broke out, right? Traded back and stuff. Can you mark out like 4 to 8.15?
Not sure why you're asking that.
Okay, because I see like a fair value gap in there and stuff. So I just wanted to cross check with you or something.
There's a fair value gap inside here.
Yeah, I see like a H1 FVG and stuff, yeah.
Wait. So let me get this straight. There's a FVG on the H1 chart. So why are we looking at the M1 for the H1 FVG?
There's a break below the I think the 8.15 range. And there's a down close candle that closed below, an up close candle traded back, and a down close candle validated it by like a paradigm shift and stuff. It's looking more of like a trade setup. I just wanted to check with you. No, it's okay.
You're asking if this is a sell right here?
Yes.
I wouldn't sell this. I wouldn't sell this at 8.22 for no good reason. So remember what I said, and remember this is a public Zoom call.
Oh, my bad. Sorry.
If you're going to be trading M1 solely with no other time frame, you have to be trading time. There's nothing significant about 8.22. So I wouldn't be looking for that trade. If you're tape reading the delivery, then you could look at it and say, this was just broken right here. No imbalances in this. This should act as resistance and push this price low. I'd watch that play out and tape read it. I wouldn't trade it. Don't just, market structure is not it. Don't just look at market structure and trade. So this is the AU that we're looking at before, or expecting price to trade higher to give you that short setup. Pop back onto, no, this is gold. Did we? I don't remember if we did gold. We did NAS. Here's that FEG. Close below it, up candle, looking like resistance. We have an efficiently traded price range with 4M open. This could act as support. Right? This could act as support. If this is acting as support, I don't want them to create a short-term high, take that high before any short setups get formed. I wouldn't want to see price trade up and then crash. So because I'm expecting that delivery, because this is efficiently traded, I wouldn't be in any rush. Just allow for them to create the reference points and then use them. And you only look for confirmation. We're not trying to frame a bias here. We already understand that this is a consolidating environment. Longs in discount, shorts in premium, that's all. It's all about how you frame a high probability short in premium or a high probability long in discount. I don't think we actually got to gold. I think this is the daily. The gray box is highlighting gold's daily range. Yeah, I think we were here. So Weekly opening price, 50% of the daily range. This right here at 50% of the daily range is our order block. I'm gonna take this off since 50% is already overlapping with the order block. I don't need multiple lines on my chart. At 50%, we have that right there and this. Trying to put it on this candle as low, so we're clear for the FEG. There's a discount array at fair value. Trading down into that, that's perfectly fine. It's in equilibrium. They could trade down here and then push higher. Perfectly fine. DXY is weak. But because I'm expecting DXY to consolidate, trade into a discount array where the market is underlyingly bearish and consolidating right now can lead to daily consolidations right there. So this is normal. If I'm going to be trading this, we'd have to go to a lower time frame and frame intraday liquidity pools and intraday reference point. So here's Monday. This is the weekly open. We opened above the weekly open in a market condition that's likely to be consolidating. We traded down into the weekly open, rejected. That creates our daily range. Here, this one is 4 or 5. This is 4. That's my daily range. So I'm not going into the market trying to form fit anything. I'm going into the market looking for confirmations only around this, which means if I'm wrong and I don't get confirmation, you don't lose any money. If you're right and you get confirmation, then you push the button. I'm not going into this environment trying to figure out the drawn liquidity, figure out order flow. Again, it's a consolidating environment. So I'm only looking for high probability premium runs or high probability discount runs. That's all. I don't know what this line is for. It's probably the daily FEG. This is the candle that takes the liquidity inside there. Well, this is the one that closes. So I would highlight this candle's high like that. And I expect my long interest to form around there. That's it. One of the questions I got, just remember, when I asked for suggestions for the next video, somebody asked about the rules. I have shared 8 or 9 rules for entry. They're not holy grail anything. They just help you to stay flat when you need to stay flat and push the button if the setup arises. First one is high probability order blocks, break market structure. Easy. So if you're looking at an order block and it's just a down candle and an up move, it's irrelevant unless that up move actually broke a market structure. And the market structure we'll talk about a little bit from this. Second one is if I have a high probability order block and it pushes higher, any retracements to this order block, let me actually find one. Here's one. Well, all of these. Let's say I'm using this specific one just for explanation purposes. Here's a down candle that led to a price swing that broke a high. Order block by definition. If I'm going to be trading this, any retracements that come back to this candle must be a down candle. So let me just highlight this specific candle. No retracements back, that's fine. Here's a down candle. When this down candle closes right here, I'll buy this up candle immediately, put my stop at the low of the order block. Calculated risk, I'll take that. If this candle that touches the order block was an up candle, I'm not interested in buying the next candle. That's rule number 2. Rule number 3 is if you have an order block candidate and inside the order block candidate, there is anything inefficient, don't try to use the open or the high of the order block, but instead focus on the inefficiency inside the order block. And those 3 should be enough. But the down candle closes beyond the BPR inside the OB. Beyond the BPR inside the OB. So the assumption is that this order block is a BPR. Okay, fair. Let's say this is a BPR. and we close lower than the BPR. If a down candle closes below the BPR, I'm not buying the next candle. If the down candle closes below the BPR and then we trade above that down candle, I'll buy the next candle. If this, then that approach.
Makes sense.
Okay. Rule number 4 is, it's called the FEG filter. We don't look at any FEGs in the same way you don't look at every order block, because how would you justify why this one wasn't traded to or something, right? You don't form fit logic. Whatever it is that you understand from a technical standpoint, you want to understand it beyond its chart example, because just looking at chart examples will always form fit hindsight data. But when you're looking at it live, how do you determine that this FEG is one I'm gonna buy, or this here, I didn't miss the move because it didn't get back here. I'm not going to buy this and hope this screams higher. I'm going to allow this to do what it's doing. Then I'll take this trade, which means you miss all of this, but then you got this. This is high probability. These, not so much. So you can make money from low probability or low quality setups, but do you want to? Of course you do. Rule number 4, FEG filter. It's for continuation trades. If I'm bearish and we take a low, right, price expands through a low, and when it expands through the low, it creates an up candle, I will sell the FVG that's above that up candle. We expand below this low, up candle, I will sell the FVG if there's one above here. There is one above here, right here. I'd sell that. Where'd you put your stop? All the way up here. But then 10 a.m. open is right here. Would you really want to sell here knowing that it's very likely to trade back to this? Nope. I would sell when this candle is trading into 10 a.m. open with my stop above here. Same narrative, just refined for precision. That's it. That's rule number 4. Yeah, the rest are I'd have to explain too many things to talk about it, the rest of them. But yeah, those are the first 4 rules.
There's also the other block rule that says
No. That's fine. That's fine. Just those are enough. There's about 7 or 8 rules. I just gave 5. I just gave 4. It's way more than anyone needs. Upside drawn liquidity. Oh, go ahead.
You have to pay for it.
That sounds like Hassan. No. It's not for sale. I'm no longer taking new members. Too many. I found
No,
out.
I'm charging you. I'm charging you.
You're charging me? This is my drawn liquidity. So you remember we talked about a while ago about expanding below an efficiently traded range, imbalances staying open, then engineered efficiency or the new origin. I don't want to really talk about that idea, but yeah. I'm measuring the range from this candle's open all the way down to here. Here's equilibrium. Inside here, everything above this red line is efficiently traded. We broke low, all that good stuff. These are internal liquidity. But this is internal liquidity in an efficiently traded range. So resistance ideas, like real resistance ideas, this is being created. It doesn't exist ahead of time, it's created. Right there, grab it, they grab it again, move lower. Because this is right here, and this liquidity pool is lower than this. My focus is on the candle that closed above this internal liquidity, which is this guy. So my first drawn liquidity, right there. The next drawn liquidity was taken by this guy. So my next focus is this guy. It's a big candle. I like 50%. 50% is overlapping with this red line. That's why my drawn liquidity is sitting right there. This is next Wednesday. I'm expecting price to chop inside here because it's a really close objective, which means if the objective is close and the week is not very volatile, we don't get large range candles. What we get is kind of back and forth movement inside here, maybe a one spike and then that's it. But I'm not expecting this range to get here, this week to get here. If it does, then great. But I'm expecting next week, Wednesday, maybe Tuesday, to get to that price level. So that means chop inside here. That's how I see it. All right, someone said I was going to explain Friday's trade on NASDAQ. So you mean that trade on Twitter when I said it's going to fall from here and then it just sank? Okay. Let's go M5. Friday is here. So there are a couple things that made me feel like Friday was likely to be a day that they're going to chop around. First thing is because Thursday got to the objective. So Thursday high of the week, normal stuff. So Thursday's high stays in the market. Again, normal stuff, classic ICT. Friday, I'm expecting to be bearish. But where would they be bearish on Friday? Where does the delivery end? For me, the delivery ends right here. That's where the daily delivery ends. Right there. That price at that time. This ends the delivery for the day. This is madness. Which is why madness started right there. We opened the next day, price traded higher, created this, then it drops. Wow, good stuff. This is exit liquidity. So I was explaining to someone, I don't remember who it was. You've probably heard the term about somebody being left holding the bag. This is what's happening when they do that. You go down here, you get a bag, you fill it with profit. Take the bag all the way to the objective, you take out the profit, then anybody who wants the bag, they buy the bag higher, then they get left holding the bag. That's profit taking. If the profit taking objective is up there, and this is happening, there are willing buyers between this level and that level who want the bag. Go get the bag, fill it with profit. Profit is below here. Take it up. They start distributing it right here. All this is distribution. Objective met. Profits are being offloaded. Models just form at objective. So we don't trade the level itself, we trade the reaction to the level. That's a difference between early entries that are correct and early entries that stop you out. This is the level. The level is being rejected. Failure swing because, introduce a little bit of madness. All of this down move is efficient. This push that started at 10 o'clock broke above this high. So remember what we were talking about earlier. When we have an expansion that breaks an efficiently traded price range, those gaps stay open. This trades down, it's not closing below this gap. In an underlying condition where you're expecting profit taking at that price, and then here, this is a failure swing. If this is a failure swing, in the order of delivery, right after a failure swing comes your opposing liquidity run. Where's the liquidity? At the high. This happens order block candidate when this up candle closes. It's not yet an order block, it's just a candidate. When we trade through the low, it's valid. So where's that thing? This is a short. First objective from the short. Low of the day. That's objective. Second objective. Lower. I shorted this. I took profit at 12,500. And then yeah, probably this one go on YouTube. There it is. Shorted that. So that's the Friday trade. At second, you're asking. That's a trade. It's actually, this position is actually still running right now. I took off 80% and I have small piece running. And
100 lots off.
nah, and I shorted this right here at 12,539.1. This high.
Hi, Kish.
Hola.
Sorry to interrupt you. Just before you move forward, can you just go back to that example that you showed us, please?
Sure.
This green box, you said, you know, when we had that drop before we pushed up,
Mhm.
you said that was efficiently traded.
Indeed.
I'm just trying to understand. It created these imbalances. So can you just explain why that was efficiently traded, please?
Sure. I'm just checking who is speaking. It sound like somebody. Sound like R3. What makes a range efficient? Open question.
What makes a
Sell
range
side and
When you
buy
have,
side delivery.
when you have both buying and selling in another area.
When you have both buying or selling, perfectly fine. Now, we have been conditioned to believe that deliveries start at the extreme high and end at the extreme low. And I'm going to humbly submit that that is a false notion. It is possible for the delivery to start at 11:35 and end at 3 o'clock, but that's not always the case. It doesn't always start at the exact high. This delivery right here started at 8 o'clock. So, all right.
Don't do it, Kish. Don't do it. Please don't do it.
Here comes the sauce.
Okay. All right. Here's what I'll say.
You
All
have to
this
think
sell
about
side
what you're gonna
delivery,
say.
yeah, right. All this sell side delivery was matched with buy side delivery right here, which makes all of this efficient.
Yeah.
This expansion here makes this a balanced price range. All of this is a balanced price range when this happens, which means those imbalances are the ones that you want to stay open.
Turn off the recording.
But yeah, that's how you could see this happening. And then when it happens with time, it makes it even better. So if this is a range, in trading ranges, the most important things are the range high, the range low, and equilibrium. This inside the efficiently traded range can act as support. All this chop.
Right, at least turn ICT down the background.
ICT is great. But there it is. See this FEG right here, discount acting as resistance now? If I was trading today, I would sell that. And I'd sell it because when we close here, created an up candle, then we moved away. I'd sell this one. That's it. I'd sell that. Anticipate this blue line to be traded to. Let's check on AU. There, oh yes, Sean. Yes, Sean. Nice try. Nice try. This is gold. This was here for explanation purposes only. Where's the drawn liquidity for gold? Gold is supposed to be chopping. This range is what gold should be chopping in. A raise below discount, a raise above discount, above equilibrium. Those should be your focus for scalps until there's a day that breaks outside of that. Because this is just low probability for me. We can find trades, but why would you want to do that? Why would you try to find low probability setups in a low probability condition? Trading like these are low probability setups in low probability condition. If the condition is already low prob, you want the highest probability below equilibrium, above equilibrium. That's it. AU chopping around. So this remains a drawn liquidity. I'd still rather them do this. They're creating that internal liquidity run now that we talked about earlier to take out and then go lower. So this is just us watching it form. I still look for that, then go higher. What if it doesn't do that and it just trades lower? Then I just don't take a trade. Missing a move means you didn't lose any money. It's a fundamental rule of capital preservation. But yeah, I'd be interested in a short idea. This guy comes back up. And if I was trying to be precise, I'd specifically want it right here. This is just extra bonus. This is beautiful, but this by itself should be enough. That should be enough. But let's see. I don't remember the other questions, but to kind of continue on the DOL lecture that we did last time. When you have the higher time frame drawn liquidity, why do you go to a lower time frame and still try to trade against it? Why do we know that this is a drawn liquidity down here and still try to buy this? Get stopped out, buy it again, then win, and then feel better.
Because most persons have been taught that you buy when the candle is going down. I know it's scary at first.
It's true, but I see what you're doing there, and you're trying to set me up.
No, not really. I'm just saying it because I tried this like yesterday, like after me, I thought, I say, oh, may I fight or buy? Why am I fighting the buy? I'm just wait until I reach us and tell it back.
Exactly.
Because the drawn liquidity is lower.
One of the
People
things that
lack discipline. To lack of discipline to follow your own rules.
True. All right.
How many persons
this.
on the call bought for AM open price just now on NAS? Like, let's be honest in that chat. How much people buy it 4 AM? Like, yeah, look on it and yeah, see they buy, but like Kish said over and over, like structure is not it. That's the only reason I didn't buy, because I know the draw is lower.
Look at this.
But,
look at this. Let's say this here is an efficiently traded price range, and you can see that right here as a big SIBI. Eight out of 10 persons are going to look for this move to get back to the SIBI. Why? No idea.
How do you get through brick walls?
Speed. But this being inefficient does not mean that this delivery must get here right now. They could crash this all the way down here, then take it higher and still crash it lower. So the highest probability setup cannot be that buy, because you don't know where the buy is going to be. The highest probability setup is to wait for price to get back here and then sell. Because when you sell here, knowing that this was a BPR and this is just a quick liquidity grab, it immediately tells you if you're wrong. It's straight above a BPR. Some of the things that you don't expect, if you're bearish, you don't want to see. Let me mute everyone. It's a lot of background. There we go. If you're bearish on a market and there's a BPR and price is trading higher, the first thing that you should be willing to accept is that we can trade through the BPR. The up candle that's coming right here, it could run deep in the BPR. That's the first thing. The next thing that you should be willing to accept or use as validation, if we're bearish and price trades through a BPR, down candles should not close above the BPR. The moment you start getting down candles closing price being above the BPR, you walk away from the trade idea. You don't care what it does. Because if this is efficient and there's a down candle above it, if we trade through that down candle's high, then it's game over. But if you wick or up candle wicks through a BPR, then it drops and takes that up candle low, I'm selling the next candle on principle. So if you take a look at any of these ranges, not a lot of stuff happening here for me to use. Let me see if I can find one. Gold. Bam, 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 bam. Not a BPR. Let's see if I can find a BPR. All right, let's use this. I don't think this is a BPR. It's just an efficiently traded range. I prefer BPRs to have, if it's one candle here, I want one candle closing through. That says speed, that says price is going somewhere, should be a good trade. This type of two candles going through the BPR says prepare for sloppy delivery, prepare for deep retracements, prepare for the move taking longer than you expect. And those are little rules that saves you a lot of time. You're looking at the price action, that's a BPR, okay, cool. I need, let's use something basic. Let's say somebody was looking at this as a big imbalance. They would close below it right here. And somebody's saying, oh, this is a big BPR. How many candles close to that? There's no way I'm looking to sell an immediate retracement to that BPR with this type of delivery through the BPR. This is telling you that, hey, they're not in a rush to take this range. There's no commitment. That move is not sponsored. So if the big money is not pushing it, the wind is not behind my trade. And I certainly can't move it by myself. I certainly can't move it at all. So this says submit. This is the BPR. Just let's say that this is your BPR candidate. And create a filter for each array that you use. BPR candidate. If I'm going to sell this BPR mechanically right here, what do I need? One candle through. Multiple candles. Even if it comes back here, we could still get that move lower. But is this is not high probability. This is not high probability. It can be a quick scalp. It can be a high probability, low quality setup. This is low quality. It's like not a lot of movement. Plus the BPR, the whole imbalance is right there. That's low probability. Price trades up inside the BPR again. Up candles are being formed. We're trading through the up candles lows. I'm probably willing to take a trade here. But this entry is being formed at 7:30. There is nothing significant about 7:30 in the market. So I'm not taking that. We return back to, I hate saying return back. We return to the up candle right there. Again on 7:40. Nothing significant about 7:40. So the setup is there, but I don't see a good trade. We return to the up candle at 7:55. Nothing significant about 7:55. Leave it alone. 8 o'clock. Cool. At 8 o'clock, we're inside this. If I could see all of this narrative real time, the moment I open the chart, I'm willing to take this trade. 8 o'clock trades below a up candle. 8:05, I'm willing to take this trade. 8:10 creates an up candle, breaking away from here. I'm selling this candle right here, this down candle. When it's trading right up here, big, as long as my entry and this price is less than 20 pips, I'm taking that. And this is 8, that's 10 points. I'm taking this and I'm open to accepting a 10-point drawdown. Those are rules, mechanical rules that keeps you out of good trades or bad trades. You could be in a trade right here. This happens and then this comes back and you close and then this happens. You start trying to FOMO in. This candle pushes higher. You cut the trade, you walk away. You come back, you see this and you start feeling some type of it. Versus having a clear approach before you get in. 95% of traders that fail, enter and then analyze. You sell this and it moves away, comes back. Zoom to a higher time frame. I'm saying, oh, this is this. It could have come back here. Let's see if it stops me out. I'll enter again. Where was all that effort before you push the button? Where's all that effort that says don't push the button yet until it comes back to here because this is a possibility? FOMO eating out all that effort. And it's true. I mean, these are things that I used to do. So I'm not afraid to say that I made stupid decisions too. All of this right here is stupid decisions. Enter and analyzing. Prices stopping right here. You look to the left, you see FEG. You start wondering if this is the order block and FEG combo to push price higher. Where's all that effort before you get enter? That's why these days I don't go to the candle and look for my draw on liquidity and all that. When I open my charts real time and I'm trading, I'm only looking for efficiency and confirmation. Look, can you enter OB? Yeah, this is the OB. This is the OB. These are the best OBs. This range is already efficiently traded. Engineered high, sponsored OB, short, speed. Versus just selling right here because it looks good. Doing with the gem at fair value. But yeah. I don't even remember what this candle is for, the line was for. Oh, this line is the order block from Monday. All that accumulation around the order block. And 4 p.m. price. 50% of the daily range. These no longer surprise me. Seeing rejections like this and reactions. Instead, they're now expected. And then you develop a if this, then that approach. If this happens, I take this on the next trade or the next candle. Objective, we didn't get there. OLR, normal stuff, nothing to be excited over. Still not a long trade. That's all I'll be looking for, potential short ideas. See if we can pop to everybody's favorite stuff. UCAD, I may have UCAD daily analysis. Yeah, I did. I don't trade UCAD that much. I just marked it up for someone else. I think this is a draw on liquidity. Get in there. Everybody's favorite pair. This right here is the example of the thing that we're talking about again. Efficiently traded, run through, breakaway, origin. These are the down candles highs that if this gets taken out, moon. Now here's the fun part. This down candle's high will still be referenced even if we trade to the low. If price gets back above this, it's pumping. So this is where if this then that approach comes in. I'm not going to be a buyer unless I see this get taken out. If you trade to the high, longs. I'll keep this on the chart just for extra confluence. This is Monday. A little M5 on Monday. Here, bam, bam, bam. My mind sees this short automatically. Can I explain that bearish POI and AUD? AU probably run this to or run this call to like 9:30 and then we wrap up. Not trading today, so I'm not gonna be cruel to my eyes. I believe this is the draw on liquidity for the person who asks. Alex, I think this is the draw on liquidity for AU. We're inside this range. This red line is the weekly open price. This is engineered efficiency. Price has gone too far. So way before any of this has happened, I'm bearish. My drawn liquidity is lower, but there is no entry. So my mind automatically says, what would you want to see to enter? Retracement. So if this is going to be the retracement, we're basically watching how they print a manipulation. Bearish POI just above. This FEG that broke out outside of our balanced price range or efficiently traded price range. Close below here, changing the state of delivery. If this right here changing the state of delivery and I'm bearish right here at 305, I start looking for the two things or the two conditions I want when bearish. And that kills FOMO automatically for me. If I'm bearish, I want to see buy side run or premium raise. So if you back test like this and you wipe off everything over here and that part, all that. At this point in time, if I was bearish and I'm looking for buy side run or premium raise, I'm going to reasonably reference that high and that low. I'm going to say to myself 50% is somewhere about here. Do we have buy side liquidity? Well, there's a little bit of razzle dazzle here. This is discounted buy side liquidity. I might not be interested in that, but this is equilibrium. This is premium buy side liquidity. Give me that. Chris Brown. That's what I want. Way before any candles start to print. This is how I'm picturing the delivery.
Could you please say that again?
Which part?
Just the last part,
Oh, so I'm saying way before any candles print, when this candle closes, if we're watching this live, my mindset would be, I want premium buy side liquidity because this is my form fitted 50%. I don't know exactly where it is. So my order block, and I want to trade below the order block, and I want to sell. And that's all you want.
Kish, ICT goes on about 5-point moves. Now, understandably in the NAS, he talks about it in the S&P. Understandably in the NAS, that's ridiculous. So, and we understand that there's many ways that we can do this. But what would be your most high probability to create 5 points for the guys on the line to just go and nick that ICT style?
On NASDAQ or S&P?
On NAS, yeah, let's say NAS. Or S&P, whichever, price is price.
All right, so let's talk a little bit about framing how you manage risk around trading a particular pair. The most important thing is spreads. Has to be the most important thing when you're trading any market. What are the broker spreads like? If my broker spreads is 5 points, for just picking 5 points because it's an easy number, I can't have a 5-point target. That's madness. Because I could enter here. Let's say my stop is 5 points and the market drops. If it comes back to my entry, I get stopped out because spreads are going to tag me. If I'm going to target 5 points with a 5-point spread, madness. So let's say the spread is 5 points and my stop is going to be here So let's say I consider the trade invalid at 5 points. So let's go bam, order block, bam. Between my entry and invalidation point is 5 points, which means when I enter right here, spreads is already going to be at my stop loss. I cannot reasonably not expect some kind of retracement to at least 50% of the order block before going low. If I don't factor this in, I'm unrealistic. Right? If price trades back to this, and this is a 5 points or 2.5, so the actual spreads is going to be 2.5 above here. This is my order block. My stop cannot be less than 2.5 points above this order block. So if I'm going to enter here, that automatically puts me at a potential 7-point stop, 7.5 point stop. So for comfort, I could put this at a 10-point level, allow the trade to breathe. Then where is my target? Is my target at least 10 points away? Because while I'm not an RR trader, RR is important. I just don't believe in form fitting a trade to be exactly 3R just because it looks good. If the target is down here, and then from my entry to here is 50 points. I don't need 50 points. I could get out at 10 points and be done. 15, 20, 25, 30. It doesn't matter. What's important is, where do I consider this trade invalid? I never try to cap how much I can make from a trade. You cap how much you can lose. So, in my opinion, I think one of the best strategies for stops and take profit for NAS is a 20-point stop and a 50-point target. It has this tendency of just hitting when you're correct. I think 50-point stop on or 50-point target on NASDAQ, spectacular. So let's say you have a 50-point target here to here. We know that nothing is 100%. So if I enter here, how am I going to manage this trade? This is 50% of the move. Do I go break even when price is at 50%? Do I mechanically take 50% off at 50%? Do I take 70% off and then leave the rest to run? However you're going to manage that, that is way more important than a point objective. Remember, there are high probability or hyper scalping algorithms, high frequency algorithms that are going into the market and grabbing 5 points, and just compounding that all day. All day, there are algorithms doing that. And they make money. They take losses too, but they make money. Because a 5-point move is easy to find. But a 5-point move is easy to find when you're trading the direction that the market is going.
Just to come in on that, I weren't literally talking about just 5 points alone. Again, just piggybacking on ICT. Understandably, if we're sitting within order flow and we've got a drawn liquidity, and whether we use something what you spoke about today, whether it be a bullish order block that's confirmed or an IOFED, we'd easily achieve those targets. Agreed. I was merely saying for the newbies on the call that don't have much experience.
Like I said, oh, okay, all good. What I'd say is this. You want to move away from the idea that you're going to have perfect entries and exits and start focusing on the narrative in the market. And when I say narrative, when you open a chart, stop looking at the market's going down or it's printing down candles, so I'm gonna look for a sell. Or the market's going down now, so I'm looking for where is it going to buy. Stop doing that. Stop doing that. You have to stop doing that.
Kish, that was exactly what I was alluding to when I said what I said about the buying a down candle. That was kind of what I was trying to allude to, like say, oh, hey, not just because you see it a print down candles mean
Sure. That's the first thing you have to stop doing. The moment you stop doing that, you will automatically stop trying to rush into a trade. And this is why I'm saying that, right? Not financial advice, just my opinion. The algorithm works on look back function. It looks back, checks for efficiency, checks for liquidity, then we start mapping the delivery. Most traders open here and they start looking here. Even if they look back, they're looking at maybe the last two candles and they're thinking it's going down, it's at a low, is it breaking or retesting or whatever. They're doing all of that, right? I think the approach should be when you open right here at 8, you're looking at where are we trading right now? What's the range we're trading in? Is the range efficient? Because you would have already determined your bias from the daily chart. The daily chart is bearish. We're opening in a range. Let me draw a scenario. So the order flow is bearish. We open inside this range. Where are we in the range? It's not just about we open in the range and that's it. We open in premium and I'm bearish. Okay, when I open in premium and I'm bearish, I'm looking for buy side runs or premium arrays. Do we have a premium array inside here? Do we have an efficiently traded delivery inside here that got to there? Because if this is inefficient, what's going to stop price from tapping the inefficiency, taking this, then going lower? Nothing. Nothing stops it from doing that. So you want to look at what is happening inside here, and then with this order flow, you try to map what's likely to happen next. There is no run on buy side when you open here. This should get taken out, which means this drop means nothing to you. This is just a retracement inside a previously established range. So what do? Where is the inefficiency inside this range? You find that. Once you find that, you find where this should happen. Price gets there, if this, then that approach. If it fills the imbalance, change the state of delivery, run higher. Start my order block right here and go short. If it's not doing that, then this trade is just going away and that's it. And we don't care about it. We don't go form fitting entries here, here, or here. Because then if you put your stop anywhere between that liquidity pool and this, you're asking to be stopped out. Because you already saw that this was likely to happen. But because you want to be in the move, you're putting your stop right there. Because putting your stop up here is madness. The range begins at 4 o'clock. My trading day starts after 8 o'clock. The daily delivery for me starts at 4 o'clock. Which means I'm gonna show something. Two different perspectives on price action that we all see. Let's say this is the daily chart. This is the daily candle. And this is 4 o'clock right here. This is the opening price of the day. And this is the opening price at 4 o'clock. Bam. Bam. Let me check the color just to highlight this. Oops, sorry. Not what I wanted to do. Where's the closing price? This is the closing price right here. So let's use that as the closing price. Some persons will see the high right there, the close right there, and this is what their daily candle looks like. Perfectly fine. That's what the broker prints. Now look at this. I see this. This is the closing price, just using that. So that's the same closing price. That's what I see. So while we both see bullish day, we're going to be looking at different reference points. I'm looking at this being the low of the day. Some person are looking at that. I'm looking at this being the opening price, so sensitivity should be right there. Some person are looking at that. This high doesn't exist for me. So everything above that doesn't exist for me. So if somebody would be looking for a potential trade back to here for something, I don't see it. I literally wipe price action off my chart that I don't need. This refines what you look at. It means I don't look at every single high and low in the market. There are specific highs and lows in the market. It means that there are some stop points that don't exist for me. So let's say we have a low right here. And then this is the start of my day. And that low gets taken out like that. And price is doing this. I reference that price level. And I want to see this. This didn't happen. But I'm not trying to make this a 2 hours call. But yeah, you have to remove the stuff that holds you back. And the first thing is doing too much, looking at too much. Narrow your focus first. Don't look at all the price action. You don't need all the price action. What's this? All that good stuff. All that good stuff. Remember retracements. In a condition like this, this first push higher should not be the highest high. It shouldn't be. Because they should be engineering intraday offset. Should be engineering intraday offset, which means they should create a high, take it out, crash. They shouldn't run back and then drop. Especially if the range is efficient. If the range is efficient and there are no imbalances or internal liquidity, the first push inside an efficiently traded range is madness. All madness. They have to push, create a high inside an efficiently traded range, then take that high out. Take it out and then they move. That's how you can start anticipating when I should probably cut this entry. I entered too early because they didn't run on stops inside here. But you'll see. So this high shouldn't be the highest high of this retracement. It should take it out and then move. But yeah, those are all the questions I remembered. And until we do this again, thank you for coming out. Hopefully you asked one. What was your question doing?
I asked you, how do you what do you look for in the hourly time frame?
What I look for in the hourly time frame? That's a pretty put me on the spot question because I only use the hourly chart ever so often. So literally what I'm doing right here, if I just get up and I'm going to trade, it's just going to be the daily chart and a 5-minute chart. Daily chart and a 5-minute chart. If I'm using anything less than a daily chart to frame my my drawn liquidity, it's gonna be the hourly chart for sure, but I'm primarily looking for imbalances. Because if let's go to the hourly chart. Let's say I'm looking at this. I'm gonna see everything right here, but I'm not going to see everything right here. For instance, last FOMC, right? And this would be the last thing that I mentioned. Let's say, where's FOMC? The day that screamed higher. last FOMC here, I sent a chart and I had a line somewhere up here and I had this low outlined, identified. You could check the chart on FOMC day. I think I had this low tagged as my downside objective. And then there was another line somewhere up here. The line that it tapped right here and it moved low. That line was specifically chosen to be this candle's low because this is a stop point. This is the higher low, so failure swing. This is also happening inside the daily delivery for me. Everything after here is irrelevant. Like I'm giving so many hints here, it's ridiculous. But yeah, this is the low I reference. That's the low I took take profit on when I shorted here. Why I chose that specific level, I could show you. Inside the daily delivery, right here, this is the daily delivery. So let me put a vertical line right there. You want to look back from here for the lowest. Well, in this case, we're already below that price. So what's the low that's above the market price? It was this one. So this is the low that came before this time in that delivery. And I sold that. And I take profit right here. That's it.
Cheeky, cheeky, cheeky.
Cheeky, cheeky, cheeky. You have to cut off some
Madness.
the price action that are irrelevant. Trust me. There are ranges in price that are just created to facilitate orders from low liquidity. You can't fill a large order on low liquidity. So you have to create a larger opposing liquidity. So this is definitely going to be the last thing that I said. So when you think about bookmaking, right, I've shared that there are 4 elements of bookmaking. 4 elements are accumulation, failure swing, opposing liquidity run, and then your entry forms. Why does it happen like that? This is why it happened like that. And then I'm going to end here before I start running off too much. Let's say the market price is right here. And somebody wants to fill an order, right? They want to purchase something at this price, then liquidate their positions at that price. A market maker has been misconstrued by all of us to be the guys that hunt you. They take your stops and that's it. The market makers are the liquidity providers. They buy and they sell, irregardless of where the market's going. If the market's going up and somebody wants to buy, they will sell it to them. If the market's going down and somebody wants to sell, they'll buy it from them. Or they'll facilitate that transaction, right? So if somebody wants to buy and this is what they want, and the market makers know that the order flow is bullish, then from a realistic standpoint, the market makers know if they sell to these guys and the order flow is bullish, they're going to lose money when it gets here. They're going to be in deep drawdown. So right here, they accumulate the orders coming in. So I'm going to try to color code this. So at this point in time, the market makers are selling. They're selling to willing buyers. Okay. After that, market trades higher. Buyers are in profit, market makers are in drawdown. Market makers not about that drawdown life, unless it's controlled drawdown. So what do? They kick them out. In order to kick these guys out of a big buy position, these guys must be willing to sell it. These guys here must be willing to sell it back to the market makers for them to buy. But their take profit is already here. That's where they plan to offset. That's where they plan to sell whatever they bought from the market maker. But they have a stop. That stop is them being willing to sell at that price. Market makers go here, buy it from them, get them out of that position. This is when liquidity is being absorbed. Market makers are now, I'll grab a green, put a B. Market makers are now buying here. That's why this confirms my order block. Then, since they're buying and the order flow is bullish, all this is done on a timely manner. They don't randomly buy and randomly sell, right? Or maybe they randomly accumulate, but this here is timed. Manipulation is timed for efficiency. When they buy it back from these guys, the order flow is going to push higher. Market makers make all that money. So this initial sell suffered a little drawdown, mitigated along these legs, or hedged along this. Just know that they're buying all of this. And that creates the order block. So now, if this here represents a pool of willing liquidity, buyers above the market, and the market makers know that. When the market's down here, and there's accumulation right here, there's this being done right here, and there's this being done right here. It's very familiar, right? Just plain devil's advocate. But it's been fun. Hopefully this pointed out to a couple of things, and enjoy the rest of your day.
One last question, please.
So somebody just asked a question.
Yeah. One last question. Can I go ahead?
Sure.
Yeah, because I'm actually new in this channel, but I really want to ask, is it very good for us to be very conversant with the particular time we are taking our trade with? Because I learned somewhere that like if I want to trade indices, I should wait for equity open, that's 9:30 New York time, to be very sure of where I'm taking the market from. Because sometimes when I take my trade prior to that time, when the equity market opens, it kicks me out before going to my direction. So I just want to have a clear reservation about that.
There are many strategies around what time of the day that you can trade. Many strategies. I don't even know all of them. But what I can say is that 9:30 brings new volatility in the market. It does. So if you're in a move that you didn't plan properly, because there are times when 9:30 opens and it just screams. There's no manipulation. But it's all about where we are in the range. So you have to factor that in. Okay? Yeah, factor that in. So this is what we're saying about NASDAQ, why that high is not going to stay in the market, and then there we have it. Swept, beautiful. Looks like it tapped order block, just a random level. I know it's going to fall. The only other thing I didn't mention on this call is this FEG right here. When I mentioned that if we have liquidity, order block, FEG, when we close below this FEG right here, that's a market structure shift. This is the market structure shift. But this is the same thing that I said without actually saying it. When this candle closes, we're bearish. We're just framing where should the entry form. I don't care about this low. I care about this FEG. But yeah, this call is getting pretty long, guys. I'm gonna save you the trouble of you're watching a long call. We'll talk about this some other time. Enjoy the rest of your day. We'll
Thank
talk
you
in the
very much.
chat, and a good one.
Thanks, man.
Definitely. Bye-bye.